The pressure mounts. Look at the indices. QQQ is up a respectable 1.45%. But this rally feels fragile. It is a liquidity play, not a conviction trade. The primary driver right now is the yield curve. Specifically, the 10-year Treasury. It is hovering just above 4.12%. That is the friction point. This is where growth narratives collide with cost of capital reality. We are seeing a bifurcation. Tech, powered by AI euphoria, is managing gains. NVDA pushing 1.87% higher, TSLA showing strength, up 3.45%. But this strength is masking systemic vulnerability. When yields dictate price, momentum becomes suspect. Retail behavior is fascinating. They are chasing crypto, Bitcoin up nearly 3%, while the established market digests higher borrowing costs. We are entering a phase where market leadership must prove it can sustain these valuations despite the Fed's tightening shadow. Watch the breadth. It is not there yet. The titans are speaking. The market is listening. Jamie Dimon is blunt. 2 words for business leaders complaining. Translation: adapt or fail. Meanwhile, the tech founder class is facing reality checks. Michael Burry is piling on. Oracle's inability to close that AI debt deal is a signal flare. It suggests the plumbing for massive infrastructure spending is seizing up under higher rates. Burry smells blood in the water for speculative credit fueling the AI boom. On the flip side, Jensen Huang sees a wacky new job emerging from AI. That is the narrative pushback. Innovation solves the cost problem. But Liquidity at the ECB is focused on the present, managing inflation expectations against growth realities in Europe. Her commentary today is crucial for transatlantic flow. Cathie Wood continues her pattern, trimming winners, specifically Tesla, pouring capital into crypto proxies. A clear hedge against traditional market volatility. She is betting on digital assets over the platform giants right now. This is the nucleus of the current market structure. We must dissect the 10-year Treasury note, currently sitting at 4.12% and ticking down slightly, a mere 0.84% drop in the session. What does 4.12% mean? It means the market is repricing the terminal Fed funds rate and, more importantly, the long-term inflation premium. When the 10-year anchors here, it sets the hurdle rate for every long-duration asset on the planet. This is the cost of capital. Consider the causality chain. Higher yields crush discounted cash flow models for growth stocks. This is why, despite strong individual performances, the broader market sentiment remains cautious. If the 10-year breaks decisively above 4.25%, the narrative flips instantly. Tech earnings forecasts, which are notoriously optimistic right now, will face immediate downward revision pressure. We are seeing a slight retreat today, suggesting short-term relief, perhaps driven by expectation management ahead of key economic prints. But the underlying trend remains upward bias for yields in the medium term due to persistent supply dynamics. The US Treasury is issuing massive amounts of debt. Look at the term structure. The 2s-10s curve remains inverted, signaling deep recessionary fears priced into the short end. But the flattening is now occurring at a higher absolute level. A steepening curve at high nominal yields is the true danger signal. That suggests stagflation fears returning, where the market demands higher compensation for taking long-term inflation risk and demands a higher real rate. The VIX, surprisingly calm at 16.20, is registering complacency. It is inversely correlated to the yield euphoria right now, but a sustained move in the 10-year above the 4.15% threshold will cause the VIX to spike violently. Why? Because the risk-free rate is now actively competing with equity risk premiums. Money managers holding capital in T-bills yielding near 5.2% are finding less incentive to absorb volatility in names like a high-flying, unprofitable tech firm. We are witnessing the return of fundamental valuation discipline, dictated by the benchmark Treasury. Every analyst note today must start with, assuming a 4.15% baseline. That is the new reality check imposed by the bond market. The movement in the 10-year is the macro pulse. Ignore it at your peril. The focus remains locked on Washington, but the ECB narrative is setting the tone for global liquidity. Lagarde's comments today are pivotal. The market needs confirmation that the hiking cycle is definitively over, yet there is skepticism about the speed of future cuts. The Fed remains data-dependent, but the bond market is doing some of the Fed's tightening work for them via elevated long-term yields. This creates a policy conundrum. If financial conditions tighten sufficiently via bond yields, the Fed may be able to hold steady longer without overt aggressive jawboning. The general macro news flow centers on housing predictions for 2026 and advice on cash equivalents. This is hedging language. Institutions are preparing for a structural shift, where cash itself becomes an attractive, non-volatile return vehicle due to high short-term rates. This directly undermines speculative equity investment. Why take the risk on a leveraged buyout or a pre-revenue startup when treasuries offer near risk-free returns above 5%? This dynamic explains the premium being placed on established, highly profitable technology platforms like MSFT, plus 1.65%, and AMZN, plus 2.48%. They generate their own cash flow, reducing reliance on external, expensive funding. Commodities are sending mixed signals, which equates to uncertainty. Gold, the traditional inflation hedge, is up slightly, trading at $4,354. Larry Fink calls crypto an asset of fear, implicitly contrasting it with traditional hedges like gold. Gold's modest gain suggests inflation expectations are still present, but not accelerating wildly. The critical divergence is in energy. Crude oil, CL equals F, is down 0.5%, sitting at $55.86. This downward drift signals weakening global demand projections. The bond market's yield pain is translating directly into bearish sentiment for industrial consumption. If the 10-year yield rises, recession probability increases, oil demand drops. The relationship is tightening. We are not getting bullish input from oil, which means the inflation narrative is currently dominated by services and sticky domestic components, rather than pure energy cost shock. The winner today, by index performance, is technology, led by the AI adjacency. QQQ is outperforming SPY significantly. We are dissecting the chip wars and the cloud build-out. Deep dive stock 1, Microsoft, MSFT, up 1.65%. MSFT is the clear institutional favorite in the AI transition. They are not reliant on one product cycle. Their exposure spans Azure cloud infrastructure, enterprise adoption via Copilot, and gaming synergy. Their enterprise moat is nearly unassailable. As Jamie Dimon suggests, robust businesses thrive when the environment is tough. MSFT is the epitome of robust. They are generating the necessary cash to self-fund this AI build-out, insulating them partially from the 4.12% Treasury rate. Deep dive stock 2, Tesla, TSLA, up a significant 3.45%. This is a momentum play fueled by Elon Musk's continued surge in net worth recognition. While Cathie Wood is reducing exposure, retail and momentum traders are still piling in, likely anticipating positive delivery numbers or FSD breakthroughs. However, TSLA is far more sensitive to consumer discretionary spending and credit conditions than MSFT. If the housing market cools and consumer credit tightens, a direct consequence of higher long-term yields, TSLA's valuation premium faces massive contraction risk. It is the high beta reflection of AI excitement, whereas MSFT is the infrastructure backbone. Watch the spread between them. Bitcoin is staging a significant rally, up 2.90% to $87,937. Ethereum is leading the charge, up 4.45%. This movement is fascinating because it occurs against a backdrop of yield elevation and regulatory uncertainty. We have Peter Schiff telling Michael Saylor that MSTR trading below NAV makes no sense. This is the eternal Bitcoin debate, fundamental asset appreciation versus institutional financing mechanics. But institutional money is flowing into the space, if indirectly via Wood's moves. The narrative driving this inflow is decoupling from traditional risk assets. Crypto is becoming an alternative hedge against fiat erosion, perhaps even against the volatility embedded in traditional stock indexes. The high watermark for Bitcoin volatility remains linked to institutional adoption. Until we see broader, less contentious ETF approvals or clearer regulatory frameworks, Bitcoin operates on its own liquidity cycle, distinct from the Nasdaq. The key level to watch is the psychological $90,000 mark. A sustained break above that suggests sentiment has overwhelmed macro pessimism. The open will be dictated by futures positioning and any late-breaking Treasury movement overnight. Expect volatility around the opening bell. Strategy remains defensive scaling. Do not chase the QQQ spike aggressively. Use any early strength to trim high beta exposure that cannot justify its valuation above a 4.1% risk-free rate. Increase the weighting in high-quality cash flow generators, the fortress balance sheet, companies. If the 10-year yield ticks lower during the session, perhaps toward 4.05%, we can selectively add to infrastructure or defensive value names. Conversely, if the yield moves north of 4.15%, immediate risk-off protocols activate. Short-duration hedges, perhaps through inverse volatility products or scaling into defensive puts, become prudent. The retail investor chasing TSLA in crypto needs capital preservation, the professional needs precision hedging. We are in an adjustment period. The era of easy money, where duration was rewarded irrespective of yield, is structurally over. The bond market has enforced the new rules. The market leaders are separating themselves not by their ability to dream about the future, but by their ability to finance that future today. Can they generate sufficient organic cash flow to service their own growth while paying higher rates for everything else? That is the only question that matters now. Warren Buffett's strategies, Bill Ackman's consolidation plays, these are reflections of capital prioritizing structure and durability over pure speculative momentum. Look for businesses that function effectively whether the 10-year is at 3.5% or 4.5%. Everything else is structural risk disguised as opportunity. This has been Dr. Finance Daily. Navigate wisely.